Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two strong stocks to consider buying amid the newly formed bear market for the S&P 500 that are probably some great longer-term opportunities for investors who are looking far down the road. So before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into these two stocks to consider, I want to take a broader look at the market and some macroeconomic factors to give a better sense of what's going on and why we're looking at these two stocks today. So very few on Wall Street thought the Fed would go off script, quote unquote, and raise their rates by anything other than those 50 basis points at its June and July meetings until that hot May CPI from last Friday. So after inflation showed no signs of slowing, traders ramped up their bets for a 75 basis point hike. And then sure enough, midweek, Jay Powell and the Fed raised rates by 75 basis points for the first time since 1994 after their two-day meeting ended on Wednesday. So Powell and the central bank appear to be telegraphing that they're prepared to really ramp up their rate hike efforts in order to try to reel in prices as best they can. Thankfully, there are already some signs that the housing market is at least cooling, with 30-year fixed-rate mortgage rates at their highest level now since 2008. And hopefully some more tightening will start to cool demand elsewhere in the coming months, and at least that's what the Fed hopes. Outside of Fed policy, obviously, Wall Street wants to see China, hopefully sooner than later, realize that maybe its COVID zero policy is a losing effort in the long run and more permanently reopen their economy instead of these stop-start lockdowns. And then obviously soaring oil and energy prices are starting to weigh on everybody, from consumers to big major corporations as well. So Wall Street's also hoping that there's some reassurances of oil producers producing more, including in the U.S. And then obviously the hope is that there's some resolution in the somewhat near future on the Russia-Ukraine front to help cool the rising oil and energy market. All that said, the outlook for the economy remains somewhat strong, even in the face of all these macroeconomic headwinds. And if we look at the outlook for S&P 500 companies, when it comes to revenue, earnings, and margins, we're still calling for solid growth in 2022 and then even more growth in 2023 and 2024. So if we now take a broader look into that bear market that we officially entered on Monday, June 13th, we're going to just kind of provide some broader bear market facts to help understand just how often we do enter a bear market. So since 1928, there have been roughly 27 bear markets and far, far more corrections. So bear markets, anytime you close below 20% from those recent highs. Bear markets have, however, become less frequent since the end of World War II, which is a good sign. So the average bear market decline comes in at roughly 33% and lasts for approximately 10 months on average. Obviously, averages are still averages, which means some have lasted for far, far longer, and others have been relatively quick. In fact, the last bear market, which was driven by those initial COVID lockdowns, only lasted for 33 days. And that COVID rebound also was historic in another way. So not only did it represent the shortest bear market, but it also took the S&P 500 only 126 trading days to swing from its previous peak into a bear market and then soar all the way to brand new highs. Now, we're not saying that's going to happen this time around, but it just shows that there's no telling exactly how long bear markets will be. But if you're a longer term investor, you're going to have to expect to deal with multiple bear markets. So the average investor with a 50-year window might experience roughly a dozen bear markets in their lifetime of investing. And no one knows how long the current one will last, but it should provide some reassurance that the average bull market lasts about 2.7 years compared to those 10-month lengths for bear markets, with a gain of 115% compared to those roughly 33% declines. So the contrast in length and percentage movement is why between the bull and bear markets, why stocks have continued to climb over the long haul. And it's also why many long-term investors take the chance to buy their favorite stocks and ETFs during market downturns. And for instance, the S&P 500 is still up around 70% from its COVID lows, even though it's entered a bear market, and up about 30% in the last 3 years. And then jumping back, the S&P 500 has surged over 450% in the last 25 years, which includes multiple bear and bull markets. The heavy selling has also greatly recalibrated stocks already. So the S&P 500 is trading below its COVID lows in terms of valuation. It's trading at about 16.2 times forward 12-month earnings, which is near its lows over the last 5 years. And if we extend the scope back to 1995, which kind of gives us the pre-dot-com boom, and today we're sitting not too far below, or not too far, we're actually below, I should say, those medians, which was it's at about 16.6 if we look back to now to 1995. So valuations have come down. Obviously, in the financial crisis lows, we were far lower than we are today. So there's no telling if we're at a quote bottom, but valuations are looking pretty enticing, especially, as I said, if you're a longer term investor. And then if we look at the 10-year US Treasury, we've already seen the market price in a big amount of rate hikes. So we're at new decade-long highs in terms of 10-year US Treasury yields, but we're still really, really low historically. If we look back to the 90s and the 80s and the 70s, we were far, far higher than we were in terms of 10-year US Treasury yields. So all of this provides context. If you're a longer-term investor, obviously, if you want to stay in cash or stay in the sidelines, that's your prerogative. But let's remember also that staying in cash comes with an 8.5% inflation tax at the moment. So we're going to look at two stocks to consider buying if you're a longer-term investor at some enticing level. So the first stock up we're going to look at is Analog Devices, which trades in the ticker ADI. So Analog Devices is a leader in analog semiconductor space that's aiming to compete against the giant of the space at the moment, which is Texas Instruments, for long-term supremacy in that analog space. So Analog Devices topped our second quarter 2022 results back in May and provided upbeat guidance in the face of ongoing supply chain bottlenecks and a slowing economy. And it continues to benefit from larger secular changes in the economy, such as electrification. So the semiconductor maker has expanded its reach to help challenge that big player, as I mentioned, which is Texas Instruments, and it completed its acquisition of Maxim Integrated back in August of 2021, so last August. Analog semiconductors are on the less flashy side, obviously, of the booming chip industry that will remain arguably the backbone of technology and really the entire economy. When you think of how the economy works, it's all tech-based. So analog semiconductors play crucial roles in countless devices and industries that next-generation digital semiconductors cannot meet. So analog chips help handle information not easily understood in those ones and zeros, such as temperature, speed, sound, electrical currents, and much more. So Analog Devices its beefed up portfolio includes analog and mixed signal, power management, as well as radio frequency and digital sensor technologies. The company boasts around 125,000 customers globally with about 75,000 products. So in terms of where its clients are coming from, about half of its 2021 revenue came from clients in the broader industrial sector, with about 20% coming in the automotive space, 15% in communications, and another roughly 15% on the consumer market side. So in terms of where it's growing the most, expects to benefit over the long haul from the constant expansion of automation and broader electrification from electric vehicles and beyond, and then as well as just advanced connectivity within the economy. So Analog's revenue and adjusted earnings both climbed by roughly 31% in fiscal 2021, driven by that Maxim integrated deal. Analog also beat our estimates in May, as I mentioned up top, and offered up solid guidance, which is a good sign. So the company's current earnings estimates are up 10% for 2022 and also 10% for 2023 since that last earnings release. And this positive bottom line revisions activity helps it land a Zacks rank number one strong buy right now. And if we look at current Zacks estimates, we're calling for revenue to climb another 62% this year to $11.8 billion, and then around 7% higher in 2023. Obviously, that reflects the slowing growth, reflects the smoothed out year-over-year comparisons with that acquisition included then over the last 2 years. Meanwhile, its adjusted earnings are projected to surge about 43% this year and then another 9% in 2023. So if we look at its stock performance, the stock is up about 75% in the last 5 years. This outpaces the broader Zacks tech sector's 60% climb, and its analog semiconductor space's 68% climb. Its shares have also fared better recently, even though it's still down about 18% in 2022. That fares better compared to tech's 33% climb in its industry's 33% fall in its industry's 27% fall. So at around $143 a share, it's trading about $23 below, or 23%, below its November records. This also provides the stock about 43% upside to its current Zacks consensus price target, which is really nice to see. The downturn also has recalibrated stock, and its strong earnings outlook has helped its valuation look pretty impressive at the moment. So it's now trading below its COVID lows at 14.7 times forward 12-month earnings, and it's now at its lowest point actually in the past decade, and it's trading at a solid discount compared to its broader tech industry. So at 14.7, it's at its roughly its lows over the last decade, and pretty much the only point it's been lower at was at the bottom of the financial crisis lows, so back in 2010 and 11. So solid valuation right now for ADI shares. So overall, as I mentioned, it's a strong buy at the moment. Zacks ranked number one, and Wall Street's still pretty bullish with 75% of the brokerage recommendations we have at strong buys or buys with nothing below a hold. Investors also get a nice bonus of a dividend along with this growth-focused tech stock. The company raised its dividend by 10% back in February, which was its 19th raise in the last 18 years. And its dividend currently yields about 2.2%, to top many of its tech peers and outpace the S&P 500's 1.6% average dividend yield. So now that we're done looking at analog devices, we're going to take a look at a company in a far different area of the economy, but one that also has some staying power long term, just like the analog semiconductor company. And this is Public Storage, which trades under the ticker PSA. Public Storage is a real estate investment trust, so a REIT, that primarily acquires, develops, and owns and operates self-storage facilities. Its portfolio includes nearly 2,800 self-storage facilities across roughly 40 states, and this was at the end of 2021. The company's been gaining momentum for years as Americans continue to buy just more things, furniture, clothing, electronics, beyond. People, either yourself has too much stuff you don't know what to do with, or someone you know very closely. I pretty much guarantee someone you know or yourself has too much stuff, and some of it might be in a storage unit right now. So tons of this stuff just ends up in public storage spaces, or including PSA's units, which can kind of be thought of as like walk-in lockers, or even ones as big as garages, or even larger than that. So people all over the country from really all walks of life pay to rent units, often on a monthly or yearly basis. And no matter where you live, in a big city or rural area, it shouldn't be too hard to spot a self-storage sign somewhere. The industry was booming years before the pandemic, and then obviously the housing boom and travel and changing jobs and moving out of state has boosted the industry as well. The company is also focused on boosting its own offerings. This includes making it easier to sign up online and manage your accounts from there. And they even have mobile apps. So they're trying to get with the times as well there. Its revenue has grown at a pretty steady clip for the past 10 years, and its revenue climbed 17% last year to help its FFO, which is essentially earnings for REITs, climb by 22%. If we look ahead, we're calling for its revenue to climb another 19% in 2022 to reach about $4.1 billion and lift its adjusted FFO by another 20%. We're then calling for another 6.5% sales growth next year and 7.5% higher earnings. And its overall earnings outlook has actually climbed not as big as Analog Devices, but it's climbed nonetheless, which is better by comparison as many industries and companies offer lower guidance that's seen their earnings outlooks fall. So if we look back over the last 25 years, the stock has done really well. It's up about 930%. This outpaces its industry's roughly 100% climb. And if we look back just to the last 3 years, the stock's up about 42%, including obviously its downturn amid the broader market pullback, which outpaces its markets or its industry's 8% decline. So at around $300 a share, it's trading 30% below its April records, and it's now trading right near its COVID lows at 18.7 times forward earnings, and which is about 20% below its 10-year median. And as I mentioned, with Analog Devices, the only time it's traded at a lower valuation multiple in the last 15 or 20 years was at those financial crisis lows. The company also has a really strong balance sheet, which is great amid an economic downturn. And just because people might be more worried about the economy doesn't necessarily mean they're just going to get rid of all of their stuff. So these storage units are things people are likely to hold on to. And Wall Street's also really high on the stock, with 9 of the 13 brokerage recommendations that we have coming in as strong buys, with nothing below a hold. And its 2.7% dividend yield blows away the S&P 500. And really, once again, it's worth stressing just how much stuff the average person and family has. And if you're a longer-term investor, it might be worth considering this as part of a diversified portfolio. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email or a podcast at zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.